Think about a stock you once owned, or almost bought, that went on to absolutely explode in value. Maybe you sold it the moment it dipped 15%. Maybe you watched it for months, talked yourself out of it, and then watched someone else get rich off it instead. That feeling, that specific mix of regret and frustration, is something almost every investor knows intimately. And here's the part that might surprise you. The problem was never the stock. It was your brain, how you think. So let's get into it. Every year, there are stocks that quietly double, triple, or even 10x in value. And every year, millions of investors either sell them too early, never buy them at all, or panic out the moment things get uncomfortable. The conventional explanation is that people just pick bad stocks. But that's not actually what's happening. The real culprit is something psychologists call loss aversion. Here's what that means. Your brain is hardwired to feel the pain of a loss roughly twice as intensely as the pleasure of an equivalent gain. So when a stock you own drops 20%, the emotional weight of that loss is not equal to the excitement you'd feel if it gained 20%. The pain hits harder, much harder. And because your brain is trying to protect you from that pain, it screams at you to sell, get out, stop the bleeding, even when every logical reason says to hold. This is why people sell great stocks at exactly the wrong moment. It's not stupidity, it's biology. Your brain is doing exactly what it evolved to do, which is minimize pain. Unfortunately, minimizing pain and building wealth are often completely opposite objectives. Then there's recency bias. This one is subtle but devastating. When a stock has been dropping for a few weeks, your brain starts to assume it will keep dropping. When it's been rising, your brain assumes it will keep rising. You start making decisions based on the last 30 days instead of the next 3 years. So you buy after the run-up when everyone is excited, and you sell after the drop when everyone is scared, which is, as it turns out, the exact opposite of what actually builds wealth. Here's where the math becomes almost painful to look at. If you invested $5,000 in a stock that 10x'd over 5 years and you held it, you're sitting on $50,000. But if loss aversion kicked in during a rough quarter and you sold at a 20% loss, you walked away with $4,000. That one psychological flinch didn't just cost you a gain. It cost you $46,000. That's not a small rounding error. That's life-changing money left on the table because your brain got uncomfortable for a few weeks. HB. And here's the part that really stings. Most people who sell too early don't just miss the gain. They watch. They see the stock recover. They see it climb past where they sold. And instead of learning from it, they tell themselves they'll get back in at the right time. They wait for a dip that feels safe enough. And by the time they feel comfortable again, half the move is already gone. The investors who actually capture 10x returns are not smarter than you. They're not better at reading charts or predicting earnings. They've just developed the ability to sit with discomfort long enough for their thesis to play out. They've learned to recognize when their brain is reacting emotionally and consciously choose not to act on it. That's the real skill, not stock picking, emotional endurance. So the next time you feel that urgent pull to sell something because it's dropped and it feels unbearable, pause. Ask yourself whether anything about the actual business has changed or whether your brain is just reacting to temporary pain. That pause might be the most valuable thing you ever do for your portfolio. Hit that subscribe button and give this video a thumbs up if it ends up changing.